Yeah. Barry, I got to say, all year long, you've been really disciplined in not following the crowd on some aspirational year-end target. I wonder if the washout internally that Mike's referencing has done anything to improve your risk appetite here on equities.
Well, we were early, no question about that, and that was wrong. But, global liquidity has been slowing. This is worldwide M2 translated into dollars. It peaked in March. It's down from 22% to about 5% and still falling towards zero. That tightens financial conditions and lowers the PE of the market. You also have the lagged effect of China's tightening. China tightened very significantly, and despite easing now, they're going to weaken global GDP into the first half. And then lastly, cyclical stocks versus defensives and stocks relative to bonds, they are very extended and coming off highs. I think the S&P drops to 4250, just below the 200-day moving average by the first quarter, a 10% correction, and then we'll reassess from there.
To Turkey, can you describe any of today's bounce to the plan announced by President Erdogan to backstop savings in lira having an ability to reverse some of the declines that we've been seeing? It just seems like more of a binary action over there versus the confluence of news that we're seeing more domestically.
Well, global central bank reserves have been slowing, and that usually begets a little bit of a liquidity crisis. Turkey is a special case, some very poor policy decisions there. No, I don't think that's the systemic risk in the market. The Omicron is actually more interesting. In less than 2 weeks, it became 70% of cases. It's not the severity of the outbreak, it's the GDP reaction and people's reaction to the outbreak. Is it mild, like Cold, or mild flu? Who knows? Who cares? What matters is if the effective R, the reproduction rate, is high in the northern states, like it was a year ago, and then becomes high in the southern states, just like a year ago after the holidays, we could double the cases in the next 4 weeks. And I think that'll have some effect on sentiment as we go into New Year.
Mike, how would you describe sentiment right now? Is it fair to read today's market action as a simple buy the dip, or do you think sentiment is really improving today?
I think sentiment is a little bit cautious and wary. I think that this kind of grind of the trading range and the average stock really suffering a lot more has kind of gotten optimism drained out of the market to a large degree. Now, there's absolutely this habit of buy the dip. We did get, very short-term oversold. I think the big question is it going to be the average stock versus the index, or is it going to be, a return to some of the mega cap stocks that have been a proxy for sort of all-weather quality over the course of this year, but have faltered recently? That's one of the big questions. I think that the other thing is whether it's, Omicron kind of coloring the macro outlook, or it's, a week ago people were making the argument the Fed's behind the curve. A week later, it's, oh no, they're going to be tightening into a slowdown. So which one is it? And I think that confusion is sort of infecting the tape a little bit. As long as financial conditions, though, don't tighten in a sharp material way, they so far aren't really doing that, even though we can see maybe something like that on the horizon. It doesn't seem like, the big blow to the market is right at hand.